Alrighty. Alrighty. Well, thank you all for being here. It is our time, so I want to make sure that we get started. Want to be respectful of everybody's time who is on this call. So thank you so much for being here. We really appreciate it. This is a part of our ongoing financial wellness webinar series, or our financial IQ series. We've been doing this for a couple of the local hospitals, as well as now we're branching out into the social media world. So we really appreciate all of you being here. We've got about 50 people playing on the call today. So, your support is the reason that we keep doing these. If nobody signed up, I wouldn't keep doing them. So thank you all so much for being here. Today, we are going to be covering the basics of investing. So whether you're a seasoned, veteran to investing, whether you're just getting started out with your first job or something like that, or you've been putting it off too long and you need to learn, today we're going to learn the fundamentals. However, no matter where you are in your journey, there should be something that you'll be able to take away from this presentation, right? So for those of you that do not know me, my name is Lucas Amell. I've been a financial planner for about 9 years now. So I don't like to talk about myself too much, but I've got a bachelor's of science degree in investment management, financial planning from Carroll University here in Waukesha. As I said, experience-wise, I've been in the industry for about 9 years now. Kind of came from a background of financial planning, tax planning, estate planning. At this point in my career, I've met with thousands of families, right? And the reasons why I do these is to just help encourage other people. My why is to encourage people to be proactive regarding their financial situation, right? I've seen too many instances, unfortunately, where people are very reactive. Something happens and that's when they feel the need that they need to start planning financially. Typically, it's better, of course, if you're doing it ahead of time, if you're being proactive with everything that you're trying to accomplish. So that's really why we host these webinars for folks, is just trying to put ideas in your head that would be a good proactive financial decision that you can make for yourself as well as your family. So organizationally, I'm kind of a thing within a thing of a thing. My parent company over there, it's called Mass Mutual. They're kind of one of the big four financial firms between Northwestern, Guardian, New York Life, and Mass Mutual. They're a parent company. However, we have an agency, which is one of the largest agencies in the country, called West Point Financial Group. So we kind of cover, the entire Midwest. There were the Midwest Mass Mutual advisors, but I'm servicing ultimately people all over the country, not in all 50 states, but I've got people in California and I've got people in Boston. So I've got both coasts. So somewhere in the middle, I'm there. Right. Areas of focus, like I said, I'm doing tax planning, financial planning, investment management, estate planning. Realistically, I operate as a full service fiduciary for people. So Advocate, as well as Children's Hospital, they kind of allow me to do these presentations just because they've received such good feedback from their various employees. So they let me keep doing them, and I want to keep doing them. So it's been a really good time. So enough about me. I know that's not why you're here. Let's talk about who I'm not, right? So I am not a CPA, nor am I an attorney. So nothing that we're going to be talking about today, please, is going to be considered or should be construed as tax advice, legal advice, or even financial advice. Truthfully, when it comes to getting financial advice, you need to be working with somebody that completely understands your situation in detail. A lot of what I'm going to be going over today is just going to be general concepts that you would be able to kind of apply. So let's kind of talk about this before we dive in. Let's understand what we mean by this financial well-being. Honestly, like I said, this is an ongoing series that we've been doing. So this is going to help, put everything that we'll discuss today in context. Okay. So financial well-being, as defined by the Consumer Financial Protection Bureau, means, first of all, having control over our day-to-day or month-to-month finances, right? So this, at the end of the day, is having a budget. It's astounding how many people I meet with for the first time, all different income levels, all different ages, have no idea what's happening with their cash flow. I'll ask, hey, how much do you make? And they won't know. And then I'll ask, how much do you spend? And they won't know. A lot of us live on autopilot. It's very important to have some kind of structural composition of what your cash flow looks like, what your income looks like, what your spending patterns looks like. We have an entire workshop on budgeting and cash flow management. If you're seeing this right now and you have not seen that one, please ask me for a recording or take a look at our YouTube channel. It should be on there. Okay. Second concept of financial well-being, having the capacity to absorb a financial shock. Okay. So what does this mean? This means having an emergency fund. There's a lot of studies out there by Fidelity, Chase Bank, et cetera, that purport that over half of American households do not have an emergency fund in excess of $500. So what this means and why it can be a detriment for folks, unfortunately, say car breaks down, you need a $2,000-$3,000 repair. Furnace breaks down, that comes out to be $4,000 or $5,000. Are you putting those on credit cards? Same with medical expenses. Are you putting these on credit cards? Are you taking out loans that are working against you? Or do you have what we call like a rainy day cushion, right? And the same could be true if you get laid off. So the rule of thumb when it comes to an emergency fund is about 2 to 3 months worth of living expenses that you have in some kind of highly liquid or accessible investment vehicle. So like sitting in a high yield savings account, just in case you need it. It's very important, to the point that they're putting it as one of the 4, right? Third, being on track to meet our financial goals. So this is hugely important. And I think step 1 with it is having financial goals. A lot of individuals do not have goals established, such as when do you want to retire? How much money do you want in retirement? Do you want to help your kids with school? If so, where do you want to send them and how much do you want to help at the same time without putting your own plan in detriment? So same deal with that. If you need help setting financial goals, creating financial goals, we have done, as well as recorded, an entire workshop. I think we've actually done that one about 3 times because it's so popular, on how to set and keep yourself on track for these financial goals. And then lastly, having the financial freedom that's going to allow you to make the choices that you want to make to live the life you want to live. So this kind of encompasses all the other ones, is having a budget and sticking to it, having an emergency fund so if something bad happens, you're set, and being on track to meet the goals that you want. You're going to have more freedom and flexibility. That's just all encompassing here. But having a budget, it's not a bad thing. It's not meant to be construed as having a negative connotation, because it sounds restrictive. But if anything, having a budget and having a management of your cash flow in alignment with your goals is one of the most liberating things you can experience from a financial standpoint. So enough about that. Let's jump into the meat and potatoes for what we're going to be talking about today. Okay, so we're going to start off by talking about why investing might be right for you. And then we're going to discuss a little bit more about investing based on your own personal risk profile. Okay, so more on that later. Next, we're going to talk primarily about 3 different common investments that exist out there. Most of you should have heard of them by now, right? So stocks, bonds, as well as mutual funds, and the various differences, kind of pros and cons between those things. So let's talk investing in general first and foremost, right? Investing, the biggest part about it is it allows you to harness the power of growth potential over the course of your lifetime. So when you have money that isn't accruing any kind of returns, keeping cash in our proverbial mattress at home, the value of your money is actually going down. And this is because it's not keeping pace with the rate of inflation. We've seen higher rates of inflation, but typically it averages around 2 or 3%. Anything that's not receiving 2 or 3% is actually losing value over time. Okay, so let's say instead of keeping the money under your mattress, you invested it in the stock market. So on our screen here is a hypothetical example of what would happen to, say, $1,000 investment in the stock market. Say we put it in 1980. Okay, so this is the numbers that we're using historical performance of the S&P 500, which is the biggest 500 companies in the economy, and just kind of fast forwarding it over that time. So, if we look at it between 1980 and now, our $1,000 only, our single deposit of $1,000, if we fast forward that during this time period, we would end up with $25,000. Okay, now of course there were some market downturns during this time as well. However, if an investor just sticks it out for the full 40-year time period, they would have had 25 times the amount of their initial investment. Okay, so it's very important. This is the reason why Albert Einstein referred to compound interest as a wonder of the world, right? It's putting your money to work for you. So it's earning interest on the interest of interest on your own money. And it's something that you don't need to actively be working for. So like ideally, by the time you're getting closer and closer to retirement, I'm usually trying to see that people are almost making more in interest than they are from their actual jobs. And that's beautiful if we can get you set up that way. And it all starts by being disciplined younger in life. So this is hugely important. And, I think in times like today, right, the market's extremely, extremely volatile. Over the past month, we've seen about an 8% decline in the S&P 500. Why? There's a whole bunch of reasons. There's tariff scare, there's a new sheriff in town and people have their opinions on them, there's a lot going on. But the important thing when it comes to investing is taking a long-term perspective or a long-term commitment. There are people that do swing trading and day trading and stuff like that. I can't wholeheartedly in any way recommend that as a retirement strategy, maybe for fun, or maybe you have, your separate fund gambling money and stuff like that. But when you're looking at traditional structured saving and investing for retirement, you need to think of it as a long-term commitment, right? There's so many trends that just show as long as you're in it for the long time, that the market typically goes up. We need to start compressing our time frames if we're, planning for retirement and you're only a couple years out. There's some things that we need to change. But if you're younger and throw it all into the S&P 500 index fund and you're pretty good. That is not advice. Don't listen to that, but it's not wrong. So let's talk about our risk tolerance. Okay, so being able to weather these markets ups and downs, it's going to have a lot to do with our personal risk profiles. All right, so there's several factors that are going to be determining your risk tolerance. I tell people, there's what the book says that you should do based on your age, your income, how close you are to retirement, but also too, there's what you're comfortable with. And my job is to kind of help people find a middle ground between those two and at least educate people, right? So like I said, the first factor when we're determining risk tolerance is age, okay? So how long before you're actually going to need the money from your investment plays a massive part in how much or how little risk your profile or your portfolio should include. So we'll dive more into this in a little bit, right? So the second factor is risk capital. So this means that the money that we're investing, if we lost it or we lost a significant amount of it, how much is that adversely going to affect your financial well-being in the current situation, as well as maybe a couple years on the other side of it? So knowing how much you know about investing can actually be another large factor when we're going and determining your risk tolerance. If you have no idea what you're doing, you have no idea what to expect, a lot of people sometimes get scared off. So like I said, right now, over the past month, the market's gone down 8%. I know some people that if they started investing at the beginning of this year, they would be like, this is a scam, this is for the birds, I'm terrified, I'm just going to put all my money back in my savings account. Whereas there's other people who are a little more, and I don't mean to call those people uneducated that are saying that, but like there's people that understand historically how the market works as well. And they're fine investing right now. They're fine putting more money in, even though they're seeing a declining market, because they're not scoped in and zoomed in saying, hey, this is how the stock market works. They know on average, we're going to see it going up. Some people would argue right now that stocks are on a discount and it's a very good buying opportunity. Okay. And then the last thing, like I said already, one of the biggest determining factors of risk tolerance is honestly your personal comfort level. This is going to play a huge role because you need to be able to sleep at night, right? So some people, they have an inclination towards being more risky. Some people typically have an inclination towards being more conservative. And then of course, there's people in the middle. So like I said, part of my job and what I, encourage people to do is be a cheerleader. Be participating in the market, especially if you're younger. If you're in your 30s or even 40s, you don't really have a huge reason to be investing in like conservative things like cash or bonds. You really want to be in the market participating, because even when we're having these negative stretches of time, if you're not in the market, you miss the good days. So like, for example, today, the S&P 500, as I'm looking at it, is up 70 basis points or 0.7%. If you freaked out and went all cash, you're missing that positive uptick day, even if it's in a declining market, which it ends up making a substantial difference of whether you're playing the game or whether or not you're on the sidelines. Okay, so continuing with risk tolerance. So the biggest thing to talk about with risk tolerance and how it relates to our investments is what we call asset allocation. All right. So asset allocation means implementing an investment strategy that's going to try to balance our risk and return, or a risk reward, by adjusting how much of each asset percentage wise is in our portfolio in relation to our risk tolerance, our goals, and our investment time frame. Okay, so the asset allocation model depicted here is just a hypothetical. The categorization of investing styles is conservative, moderate, or aggressive. It's simply a suggestion. Okay, so this is a suggestion for consideration. It's not really meant to be advice. It's just to give you an idea of what we got. So this risk tolerance concept, it's only going to play part of a role. At the end of the day, you need to determine what's appropriate for you. However, just so you know, this is how risk tolerance relates to our blend of investments. So the more aggressive you should be, you're going to have more and more equities or stock positions. Okay, so that's like the far left corner here. The older you get, the closer you get to retirement, or the more conservative, less risky you feel, we're going to see more of a balance of bonds as well as cash, kind of tapering off those equities. So like, for example, when I'm talking about like, hey, we've seen a negative 8% return in the S&P 500 over the past month, that doesn't apply to bonds, right? So bonds, they're kind of the steady Eddie investment. I'll talk about them more in depth, but that's what this is showing is typically, our risk tolerance is going to be in alignment to how we have our investments structured in our 401ks, in our IRAs, stuff like that. Okay, so asset allocations, the way your portfolio is going to be divided amongst these investments, your portfolio makeup, right? So our risk tolerance is going to help to determine how much of your portfolio should be invested in stocks, how much should be in bonds, how much should be in cash. This pie chart is just showing a moderate portfolio, right? So let's take this a little bit step further by having a mix of stocks, bonds, cash equivalent, whatever that mix might be. You have created diversification for yourself. So simply putting, being diversified means combining a variety of assets and seeking a reduction in risk to any one of those particular asset classes. This strategy works oftentimes because different asset classes or categories of investments may not be moving in the same directions at the same time. So as one goes down in value, one might be going up in value, vice versa. So it's important that we have that diversification, not, like the cliche quote says, you don't want all your eggs in one basket, right? You don't want to have a retirement portfolio built 100% on Tesla stock, because as we've seen in the past, month, I think Tesla stock, or at least over the course of this year, I think it's down 30% already. Whereas you can own a portion of Tesla stock, but own multiple other companies. And then even though Tesla's doing poorly, some of those other companies will help keep your portfolio afloat. So diversification helps to give you a little bit more of an averaged trend line when it comes to your rates of return. Okay, so kind of continuing on this risk tolerance and diversification talk point, a common path towards diversification to reduce our overall risk or the volatility that we're seeing in a portfolio is not only to invest in a variety of asset classes or types, but it's to invest in different categories as well. Okay, so we're starting to break this down, right? So there's different types of stocks, for example. There's value stocks, there's income stocks, there's growth stocks. What do all these mean? We'll dive into each one of those a little more individually, just to kind of peel back the sheets to give you a good understanding. But even people who are known to invest only in stocks, right? You can still operate different categories within the stock bucket to help give you more diversification. So there's even, I don't even know if it's on this presentation, there's different like industries that you can invest in as well within the stock world. So like healthcare, personal finance, defense, pharmaceuticals, there's a variety of things. So it's important to kind of have exposure to all these different things, once again, to give you diversification. So there's a lot of different ways to diversify. So somebody asked a question, is risk tolerance dependent on how much capital that you have to invest with? Absolutely. Yeah. So there's a lot of things that go in to build out what risk tolerance is, what that means. And part of that absolutely is how much money that you are working with. And like I said, going back to that concept of risk capital, meaning, hey, if you see a downturn of 8% in a month, how much is that going to influence your plan? And that answer is drastically different if you are 1 year away from retirement compared to 5, compared to 10, regardless of how much money you have. But the amount that you're investing and playing with does definitely have a factor into how risky you should be. Okay. And what a lot of people find success in, and I do this all the time, especially with people who have a good chunk of assets, is they'll create what's known as like a bucket strategy system. Okay. And what that means is they'll have, say you have whatever, $100,000 that you're playing with. I just like even numbers, right? Maybe we put 30% of it in something that's, going back to like this. Hold on, is this gonna work? Yeah, going back to this, right? Saying, hey, maybe let's put 30% of it into the conservative bucket, 30% of it into the moderate bucket, and then, the other, whatever, 35% into the aggressive bucket. So that helps, create a systematic withdrawal strategy, saying, well, like, hey, if the market's doing poorly, I still have 30% of my asset in this conservative bucket that I can always spend down over the course of these years to give these other buckets time to recover in a down market. So there's a lot of different strategies that you can do. Risk tolerance sometimes can be portfolio specific, right? So a lot of times when I'm working with folks, they might have a traditional IRA as well as a Roth IRA. We say, hey, I really want to kind of save my Roth money for down the road, or it's more of a legacy play. I want that to be part of my estate to go to my kids. Maybe we'll have the Roth being aggressive, knowing that, hey, we're not going to tap into it for longer. Let's swing for the fences, and statistically, it should get us more rate of return long term. And then your IRA, which is going to be the money that you would use to supplement your retirement cash flow, maybe we have that in more of a moderate conservative portfolio, because you're going to need it in a shorter time horizon. So where was I? I distract myself sometimes. Why diversify, right? So bottom line, while asset allocation and diversify don't ensure a profit or necessarily protect you against loss, they are going to help you potentially lower our investment risk, as well as help increase the chances that you're meeting your goals. Because like I said, it's going to create more of an average trend line versus seeing like as big of a fluctuation as if you were investing in like just an individual security. If you're doing individual stocks, one earnings report can tank your position by 15%, but it can also spike your position by 15%. So don't put all your eggs in one basket. Don't put all your money into one stock. But since we're on the topic of stocks, let's talk about them, right? So there's generally three main types of stock positions that we're going to be looking at, okay? There's going to be income stocks, growth stocks, as well as value. So income stocks may be invested in or selected because they're going to pay a dividend. So some strong dividend stocks that I see, like GE Healthcare pays a good dividend. A lot of them do nowadays. What that means is, say you own a position year over year, and they're not guaranteed, but year over year, these larger companies that are dividend-oriented stocks will say, hey, since you are a shareholder of our stuff, we'll pay out a dividend. Actually, I think I'm getting ahead of myself. Just remember dividend stocks. Growth stocks, they might be selected because of their growth potential, right? So instead of paying out dividends, what a growth stock does, and these are usually smaller companies, they'll say, hey, we don't pay dividends to our shareholders. We're reinvesting all the money that we would use to pay dividends to further expansion. So people invest in growth stocks because they're looking for raw appreciation value. And then, of course, we're looking at value stocks. So the idea behind value stocks is people would argue that, hey, based on my analysis or this person's analysis, this company is actually at a discount. It should be worth this, but for some reason, the market's placing it here. I'm going to buy it here because I think it should be worth more than it is. So as we begin to get a little more in depth with each of these different types, please just keep in mind that each of one of these, it's still going to have its own subsets, right? So each of these subsets is going to be defined by their market capitalization. So the total amount of shares that are out there times the price. So here you'll find stocks, and they'll go by these common names. So there's large cap stocks, which are typically companies that, they have a value of $10 billion or more. There's mid cap stocks, which are typically between 2 million and 10 million. And then there's small cap stocks, which are usually between 300 million and about 2 billion. So there are thousands of different stocks that you can pick from, all within these different categories, all of which have different subcategories based on how big the companies are. So I know it seems overwhelming. It can be, but truthfully, the more that you know, the less complicated it gets. It just sounds a little scary the first time you're hearing it, right? So let's do a little bit of a deeper dive into each one of those individual three, and then we'll keep moving. And I'll make sure to be respectful of everybody's time. I should run like right up to 1 p.m. Central, okay? So let's talk dividend stocks, right? So generally speaking, like I said, when you buy a stock in a company, you are becoming a part owner in that company. Now, not all stocks pay dividends. Even ones that historically have do not guarantee them. However, usually these dividend stocks are going to pay regular dividends because that's why a lot of investors intentionally place their money there. They're not as much placing it there for appreciation. Typically, a dividend stocks are going to be more in these matured industries. So income stocks, they can be found in industries that are going to have lower volatility. So like the energy sector, financial sector, natural resource sector, these companies, they've got limited growth because they're very established. However, they still have a need for capital. They still want people to put money with them. So what they do is, when your money is there, they'll issue these dividends almost as an incentive for you to put the money in something that you know is not going to receive the massive capital appreciation. However, they still want to share in some of the profits with the shareholders, because ultimately, at the end of the day, we are what's giving these companies working capital to fund expansion, fund new products, stuff like that. So these dividend stocks, people use them to kind of create an income within their portfolio. Just think about it like that, okay? growth stocks. So growth stocks, as I said before, they're usually not paying dividends to their shareholders. The company wants to reinvest any of their profits back into the company so they can continue to grow, continue to expand. So you're going to find these growth stocks oftentimes in like the technology center or the technology sector, just because that's where the opportunity for growth really is coming from. You know, it's probably higher in tech than any of the other industries, especially nowadays with the boom of AI, right? So, you know, we're seeing like the Palantirs of the world and the NVIDIAs and even Meta and Tesla, you know, those are all tech stocks and they're booming right now. They have been for the past couple of years. So these growth stocks, however, although they're not carrying the dividend, they have the potential for growth. Typically, they're going to carry more risk for you, the stockholder, because you're going to be retiring completely on the success of whatever company you're investing in to generate that rate of return. Remember, versus the dividends, which they're going to kind of just pay out a dividend regardless because they're stable. These companies, if they're not growing, they're losing you money, right? So if a growth company was below what it's expected, so like I said, these earnings reports are really, really big when it comes to these individual stock positions. If they release a poor earnings report, you could definitely lose money as market confidence is going to start to, you know, drop that stock price. So ultimately, the market perception of a stock is what determines its price. Even if a company is performing really well, I've seen stock prices tank because of poor management, like a CEO getting in a scandal and then they had to rush and find a new one. Their earnings were fine, they were growing, whatever, but the stock price can still tank because it's purely based on market perception and the perceived value of that security. So speaking of market perception, it's particularly important for value stocks. So that's our next one, right? So value stocks are chosen based on strong fundamentals, but negative market perception. So this is like what I was saying earlier, where say we're looking at, and this can be for income driven stocks or growth stocks. So let's use like Walmart as an example. Say Walmart fundamentally was having a great year. They were recording record profits. They were seeing expansions, XYZ, all these good things happening. But their CEO got a DUI and the stock price tanked 7% because they're like, we don't have a backup CEO or something like that. What value stock investors would say is that price, the company is discounted. Walmart, you know, it's going to continue running. It's going to continue ruling the world. They just had this blip. And now I'm seeing this as a buying opportunity, right? So there's many reasons for negative market perception, but oftentimes it's because, you know, the company is receiving negative publicity, they're going through legal troubles, they're having lower expected earnings. Investors in these value stocks are looking for these stocks to buy them at a low cost because when the market's not perceiving it as valuable, and then they could sell them down the road when the market kind of readjusts and starts seeing that company a little more favorably. So those are the big three, right? So like each of the asset categories, the stocks, they're going to have benefits, they're going to have risks, okay? So the benefit that stocks are going to offer is more potential for growth than we're going to see in the bond space, in the cash equivalent space, especially when we're zooming it out, looking at a long-term perspective. Now, the risks inherent with stocks, of course, are that their returns are not guaranteed for your investment. You could potentially lose all of your value, right? I don't typically see companies go completely zeroed, but it is possible, right? So inherent in stock investing is market volatility, okay? And that's the biggest thing. We'll talk about that for just a moment, right? So if you are going to invest in individual stocks, you need to be prepared for price fluctuations, okay? So on the screen here is what we call the periodic table of investments, okay? So the colors on this different chart are going to reflect different like indexes that we're going to be using. So like the Dow Jones Industrial Average, which is stocks from the 30 most influential US companies, the S&P 500, which tracks stocks from the top 500 US companies, then NASDAQ, which is stocks traded on a different stock exchange called the NASDAQ. So like every year, different ones of them are going to perform differently. Okay, so there's kind of two main things to note about the chart, right? Not all stock classes perform the same. Okay, what's great one year can be terrible the next year or in subsequent years. Just because your stock's performing poorly too, it does not mean that it's not going to recover. So like, for example, if we look at it, right, in 2018, so like look at my emerging markets, right? In 2018, emerging markets was the worst thing that you could have your money in. It returned almost a negative 15%. However, the next year, it returned 18, kind of middle of the road. And then following year, it returned 18. So, you know, these things are going to be blended all the time. And that's why that name of the game when it comes to investing is diversification. Realistically, having exposure to all of these different things is going to help even out your rate of return. And especially too, if you are investing in retirement or you're very close to retirement, you want different buckets to pick from to help supplement your lifestyle in retirement to give other stuff time to recover. So like, let's use 2018 as an example. Say you're living on a fixed income and you need to be tapping into your retirement portfolio $10,000 a year. Well, if all of your money was in emerging markets, that's where you have to take it from, okay? And it's really going to hurt you when you're drawing from something that we would call a depressed asset, meaning the money is already going down and down and down and down, and then you're pulling from it as it's going down. It's really going to exacerbate the negative impact of a market downturn on your portfolio. However, somebody that's properly diversified in this situation and they need that same $10,000, what we could do is look at some of these things that were less impacted than our emerging market bucket, right? So whether that means looking at our cash or even to something that was still negative but less negative. So like our large cap equities, that was only down 4.3% versus the emerging markets, which was down 15. You know, so there's a lot of games that you play, and truthfully, that is why diversification is so important, specifically for retirees, is because it gives you different places to pull your money from when you need it. And it gives your other stuff time to recover. So let's do a crash course on bonds, right? I've got about 20 minutes here. Hold on one second. I'm talking a lot. All right. So bonds, generally speaking, a bond is, I just want to make sure. Okay. Yeah. A bond is used by a company or a government entity in order to help raise money from financing some kind of project or some kind of activity that they're working on. Okay. So when you purchase a bond, you're essentially giving a loan to an organization, whether it's a municipality or even like a corporation. They all utilize bonds in some way, and we'll kind of go over that. So what they do is you're giving this loan to an organization, and that organization promises you contractually that they're going to repay that loan plus some kind of interest over a specified period of time. Okay. So your bond will contractually specify both the interest rate that the company is going to pay you and how long you need to keep that money there, or how long they have to repay you for that loan. So earlier, when we were kind of talking about the stock purchases and how you become an owner of that company, bonds are a little different. You know, when you buy a bond, you're becoming a debt holder or a creditor to the company. Okay, so you're not an owner, you're a debtor. So it's just important to know. Okay. All right, so let's go over it. There's three main types of bonds similar to how there were for stocks, right? So corporate bonds, these are debts and contracts issued by private or public corporations. There's municipal bonds. which are issued by states, cities, government entities. And then there are treasury bonds, which are issued by the US Department of Treasury on behalf of the federal government. Okay, so let's kind of talk about each one of these individually. Did it not switch? No. All right, corporate bonds. So bonds, they're issued in blocks of $1,000, less important. These typically they're going to receive the interest from the issuer until the bond matures. In the case of bankruptcies, and this is very important, if a company goes bankrupt, bondholders are actually placed first. So like versus stockholders, like if a company goes belly up, stockholders are one of the last people to actually get paid. So that's why your value can go to zero. Bondholders, since you are a creditor, you have preferred payout if the company doesn't work out. So it's important to know just one of the ways that you can buy bonds is issued directly by like for-profit companies. Municipal bonds, like I said, the interest is going to be coming generally from these municipalities. Therefore, since they are government entities, they actually usually are making that interest to you tax-free, or at least federally. Sometimes it can be state depending on who you're buying the bonds for. So before purchasing a municipal or government bond, please seek advice from an accountant or a tax specialist to really understand what your tax ramifications are. If you're buying bonds in like a 401k or an IRA, taxes don't even matter. But if it's outside of that, they can get a little more complicated. But generally speaking, municipal bonds have a very low default rate. So like the risk of you losing any money on them is very low, because that would be like, hey, the city of Milwaukee went bankrupt. Sorry, we can't pay our bonds. That would not really happen. I mean, Chicago's been bankrupt for years. Like, honestly, if you look at their balance sheet, they're still paying out on their bond promises. So it's just good to know. Treasury bonds, right? So treasury bonds, you buy them from the US Treasury. You don't really need to go through a broker or anything like this. So these are usually very, very low cost, and they're backed by the full faith of the US government. They're generally seen as risk-free investments, and I can actually say that for that one. Normally I can't say that. So they don't provide a massive amount of return. However, it's usually meant as, hey, this is a super safe place that I can be parking my money, and it's hopefully not going to be losing money to inflation, like we talked about earlier. So this is a big one. I would say this is how nowadays more and more people are invested, is through mutual funds, which we talk about. So, we talked about diversification earlier. Mutual funds by nature have built-in diversification. Okay, so that's because the more money that you're putting into a mutual fund, they're going to be buying all these different investments for you. Okay, one of the second primary benefits of mutual funds is that they're professionally managed, right? So in other words, the investment decisions, they're made for you by experts. Okay, so just so you know, you have to pay for that, right? Mutual funds do have an inherent cost. However, they have like teams of people, usually buildings of people, where it's their full-time job to just be doing research behind a computer, picking out a blend of, say, 50 to 100 stocks. You give them $100, and then that $100 gets spread amongst all of these different stocks that these teams of smart people with letters behind their name say, we should be investing in this. Right. So it's pooling a bunch of money together to automatically diversify people amongst different things that they think are viable. Right. So same thing with stocks, same things with bonds. When it comes to mutual funds, there's all different types of mutual funds that you can be invested in. Right. So money market mutual funds, of course, they're going to be composed of short-term securities. The objective here is to earn interest while kind of maintaining your principal. So steady Eddie kind of thing. Stock mutual funds, right? They're going to be invested in a variety of different stocks, and they can be made up of different income stocks, different growth stocks, different value stocks, some kind of combination. Each mutual fund that you invest in or would invest in potentially is going to have its own directive, right? It's going to have its own objective. It's going to have its own goals. It's going to align with a certain risk tolerance, and all of them are different. So that, for example, stock mutual funds, you can go out there and look for a aggressive technology stock mutual fund. There's probably thousands of them. You can go out there and say, hey, I want a balanced mutual fund that's invested in technology, where they'll have half of it in tech stocks and half of it in tech bonds. There's so many different ones out there, and they probably come out with 1,000 new mutual funds a day, right? And then lastly, I mean, there's bond mutual funds too. I think that's redundant compared to the stock one. It's just a portfolio of all bonds that you can be invested in. And then lastly, and I'll kind of scope in on this one because a lot of people actually own this last category, and whether you're aware of it or not. Okay, so this target date mutual fund concept, target date mutual funds, they're going to invest in a variety of different stocks, of different bonds. However, what happens with these, I think it's the next slide too. Yeah, there we go. Okay, what happens with these target date funds is you pick a date way, way, way out in the future. Okay, so it's typically in alignment with the year that you turn 65, which is they're calling your target date, or the date that you would retire. And slowly over time, as you get closer and closer to that date, they're going to make the portfolio automatically more conservative. Okay, so say your target date's 30 years from now, right? So you're a 30-year-old and your target date fund is set to be the year 2055, right? Initially, you're going to have a way bigger skew towards being invested in equities versus bonds. However, as you get closer and closer and closer to that date, the target date fund is automatically going to adjust what your balance between stock position and bond position is for you. So it's meant to be very hands-free. It's meant to be very easy for do-it-yourselfers. Almost everybody is defaulted to this option when you sign up for a 401k, just because the ease of administration and the ease for you as an investor can be very good. So if you have a 401k and you never look at your investments, go take a peek at the website. Very likely you're automatically just invested in a target date mutual fund, and the date that's picked is usually a year very close to when you would turn 65. So these ones, just know, big takeaway is that the risk tolerance automatically adjusts for you over time, the closer and closer you get proximate to 60 or 65. Now, that's a pro, is the hands-free. The con with these target date funds is that they do not take into account at all what's actually happening in the stock market. Okay, so they're in no way tactical with how they're positioning your investments. They're only looking at how old are you today? When do you turn 65? They are not looking at, hey, is the market tanking right now? Is this a buying opportunity? Should we move something because this is happening? Should we get out of this sector because this happened? They don't look at any of that. They're purely looking at your age. So it's very important to keep that into consideration too. Okay. So this kind of literally what I was just saying. I always jump ahead of myself, but this is all mutual funds. Okay. So with mutual funds, like each investment types, they're going to have their risks. They're going to have their benefits. They're going to have their pros. They're going to have their cons, right? So the benefits are built-in diversification, right? You put that $100 in, you don't buy one company, you get 100. So that's huge. Professional money management, having teams of people picking your stocks. So first of all, you don't have to spend all the time. You don't need to be staying up late at night thinking whether or not, you pick the right things. If it doesn't work out, you can go blame the money managers. Some people really, really like knowing that they don't need to take responsibility for selecting their own investments. Okay. And then this is going to give you a better exposure with a small amount of capital. So some of these companies and some of the positions that some of these mutual funds own and help you participate in, they will only accept investors with $1 million or more. Whereas you can actually get and participate in investments like that with those institutional investors, because these mutual funds are pooling billions of dollars together and purchasing things. So you as an individual investor would be able to actually have access to things that normally, based on your level of wealth, you might not have access to. Okay, so risks that are associated with them. Fees, they can often offset any kind of positive benefit from you being in these versus being in an index. Fees are a big part of investing. You should know what you're paying at all times in terms of fees, because usually there's lower cost alternatives that basically do the same thing. Okay. Also, to fellow investors, selling at a low point, the funds can suffer. So there can be tax exposure. Once again, we're not going to be talking about taxes today, but mutual funds, especially if it's in what's called a non-qualified account, they can get kind of messy with taxes based on gain distribution, spitting off dividend as well as interest. But we're not going to dwell on taxes for today. Okay. So I know we're winding down on time. We got about 10 minutes here. Two other types of investments that a lot of people have heard of. I would say that ETFs have gotten more popular. So, we've discussed a lot of the primary vehicles, stocks, bonds, mutual funds. There are a lot of different other types. These, I would say, are the two most common. So exchange traded funds, or ETFs, which the goal of these is to track an index. So it can track like a commodity like gold or soybeans, or it can track something like the S&P 500. So unlike a mutual fund, an ETF, it just trades every day, similar to how a stock would. There's no professional management, really, nothing like that. They're usually very, very low cost. So some people like some people like having the money managers. I personally am a big fan of ETFs. I think, especially like I said before, for young people, throw everything into a general growth ETF and you're going to be pretty good. You can start planning and really adding diversification once you get like 10 years out from retirement. But these ETFs are a great thing. Okay. Another type of investment, I don't see these as popular anymore. They get popular when there's a lot of like real estate boom and stuff like that. But these REITs, they're called, or real estate investment trusts. It's mostly just investments in real estate and mortgages and stuff like that. They're bought and sold on the exchange, similar to mutual funds. I don't see a lot of people getting into them, but we did want to put it in here because I get questions on them still a lot. These two types of investments, they are a little more complicated, even though it sound like I made the ETF thing sound less complicated because of how they're issued. They are a little more complicated. So it's important that if you want to be participating in these, you're talking with your financial professional. Okay. So kind of recapping on everything, as you're building out our investment portfolio, consider the various types of investments that you're going to be using. You can use this risk pyramid to kind of check your plan against risk. The bottom of your pyramid here is going to be comprised of our low risk investments, such as bonds, such as money market accounts. The middle of our pyramid is going to be made up with growth, more growth oriented stuff. So our stocks, potentially even some bonds. And then the top of our pyramid, this is kind of like that food pyramid. It makes me think of, our sweet treats are going to be the super speculative things. So this isn't an end all be all. Just be aware that there's a lot of different ways that you should structure it. So as an overall review, we discussed a lot today. I tried to not dwell on certain things for too long. I feel like I'm naturally a talker and I really nerd out about this stuff. So I hope that you were able to find some value with this. When we're looking at, some of the ways to remember how to investing, just always think of the acronym DAD, right? Good old DAD. So DAD. D, determine your risk tolerance or your risk comfort. A, allocate your investments according to that. And D, diversify. So determine risk, allocate according to that risk, diversify amongst different asset classes. If you do that, you're going to be well on track for a good financial life. If you have questions, if you need assistance determining your risk tolerance, you want to review your 401k or your IRA and how it's set up, please do not hesitate to reach out to me. Here's my contact information. Also to check out our YouTube. If you just kind of, I'll link it to everybody in the email follow-up that I give. Here's a picture of me being a cowboy. I just got back from Nashville at a recognition conference, and I don't want to tell you how much I spent on that outfit while I was there, but cowboy boots are really expensive. So thank you all so much for attending, whether you're here or other two, if you watch the recording. We really, really appreciate all the support and positive feedback that we have been receiving so far. I will hang out here for a couple more minutes. I've got till 1 blocked off on my calendar. If you have questions and you want to type them into the chat box, I still see we have a good amount of our participants on the call. There should be a chat box you can punch questions into. If it's general in nature, if you ask a super specific question about your individual circumstances, we should just talk offline. But if I went over something and you just want additional clarification, I'm more than happy to chat for a little bit right now. But thank you all again for attending. We really appreciate it. And have a good day. It's almost spring. I think it feels like spring. When's the first day? I think the first day of spring's March 21st. So we're getting closer here. I love it. Yeehaw. I love that. Thank you. All right. Well, I'm not seeing too many questions trickle in, so I'll get off. If something comes up after the fact, feel free to email me. Thank you all again. Have a blessed March. Talk to you soon. Bye, everyone.